Welcome to the Deep Dive, where we take your reading list and turn it into instant expertise.
And this deep dive is a really interesting one. It's customized for you.
Yeah, we're hitting that fascinating intersection of modern retail investing and, well, the dominance of the big tech giants. It feels unstoppable.
It really does. And today, we're looking at what everyday investors are betting on for the next couple of years.
Right.
The sources you share give us this incredible snapshot of the current retail mindset. We're basically looking at the portfolio makeup from Robinhood's 100 most popular list.
And what's striking is just how concentrated it is. Retail investors are, placing their chips on 5 specific members of the Magnificent Seven.
Just 5.
And then they're balancing that sort of with just one popular ETF. So our mission today is to really get into the why behind these specific picks.
I think before we get to the stocks themselves, we really need to set the scene. I mean, this level of retail power is a very new phenomenon.
It's what the sources call the retail investor revolution. So let's unpack that. If you go back 3 decades, the internet did more than just, open up e-commerce.
Oh, way more.
It completely dismantled the information wall that always stood between Wall Street and Main Street.
That's the key. That information used to be so expensive, so proprietary. You needed a Bloomberg terminal. You needed costly research just to do basic analysis.
And now anyone can pull up an income statement, a balance sheet, regulatory filings. It's all just a click away.
And that access to data collided with, well, a perfect storm in the early 2020s.
The numbers are just staggering. I was looking at the Retail Investor Report, and it found that in 2020 and 2021, something like 30 million retail investors opened new brokerage accounts. 30 million.
That's just a hobby. That's a market force.
Yeah.
A huge force. By 2021, retail was accounting for 25% of all equities trading volume.
A quarter of the market, and that's almost double what it was a decade before. They basically became relevant overnight.
And platforms like Robinhood just poured fuel on that fire.
How so?
Well, their whole model was built for it. Commission-free trades, the ability to buy fractional shares. It took away the mental barrier of needing thousands of dollars to start.
So that brings us to what they're actually buying. And as we look at these top holdings, there are sort of 3 big themes that jump out.
Right. The first is the big bet on AI and cloud infrastructure.
Then you have this reliance on consumer loyalty and capital returns.
And finally, it's this mix of, let's call it maverick ambition and just pure diversification.
Okay, let's start with those infrastructure bets. And we have to begin with the stock that really shows the shift in retail thinking.
You have to. We're talking about Nvidia or NVDA.
Which is now the #1 most held stock on Robinhood. It actually knocked Tesla out of the top spot.
And that's a huge deal. It signals a move away from just betting on a charismatic CEO to betting on a critical piece of market infrastructure. I mean, Nvidia is the face of AI. The stock has rallied, 1,200% since the start of 2023? It's incredible.
So the bull case is just. It's pure hardware dominance. We're talking about their GPUs, their graphics processing units.
The Hopper H100, the new Blackwell series, they are the backbone of every major AI data center.
And the market share numbers are, well, they're hard to believe. Analysts consistently put NVIDIA's control at 90% or more of all GPUs in enterprise data centers.
That's a monopoly in all but name. But the real moat, the genius of it, isn't just the hardware. It's the CUDA software platform.
Explain that. What is CUDA?
Think of it as the language you need to speak to the hardware. It's the proprietary software layer that developers use to unlock the full power of those NVIDIA chips.
So it's like a proprietary operating system. If you build all your AI models on CUDA, you're now stuck.
You're anchored. Exactly.
Yep.
Moving to a competitor would mean rebuilding everything from scratch. That software lock-in is, I would argue, an even stronger moat than the chip itself.
But the sources do point out a headwind here, even with this incredible growth story.
Yes, there's always a but.
The history of AI stocks is just incredibly volatile. Any sign of a slowdown could, as they say, spoil the party.
It's an ambitious bet, for sure, and it comes with that volatility.
Which actually leads us perfectly into the second infrastructure play. This one feels like it has a safer foundation.
You're talking about Microsoft, MSFT.
Right. The 5th most held Magnificent Seven stock. And their whole strategy is about weaving AI into their existing high-margin services.
Anchored by their cloud platform, Azure.
which is the #2 cloud provider in the world, right behind Amazon's AWS.
And it's growing like crazy. Sales are up 40% in the first fiscal quarter. This is where a lot of those Nvidia chips end up being used.
But what I think makes Microsoft so different from a pure play like Nvidia is the power of its legacy businesses.
The boring stuff that prints money.
Exactly. Windows, Word, Office, they provide this incredibly stable, high margin, and most importantly, predictable cash flow.
Immensely stable. I mean, Windows still has nearly a 70% market share on desktop PCs globally.
Yep.
That cash flow basically funds all their big bets in AI and the cloud without taking on huge risks.
Well, let's talk valuation for a second, because this is where you can see the difference in investor thinking. Microsoft's trailing PE is around 35.
Which isn't cheap.
Not at all.
Yeah.
But it's backed by that explosive Azure growth and the stable legacy cash for a company with sustained double-digit sales growth.
You can kind of defend it. You can make a rational case for it based on future profit growth. We'll see how that compares to our next stock.
Okay, so we've covered the infrastructure bets, but retail investors also just love to buy what they know.
The familiarity principle.
Which brings us to the ultimate consumer loyalty play, Apple or AAPL.
And what people know is a brand with incredible loyalty and, frankly, insane pricing power.
The numbers back that up. Ever since they launched the 5G iPhone back in late 2020, Apple has held around 50% or more of the U.S. smartphone market. They own the premium end.
Absolutely.
But the real investment case here, the detail you have to understand, isn't just selling more phones. It's about a financial mechanism.
You're talking about the capital return program, the buybacks.
Exactly. Let's just break that down simply. When a company buys back its own stock,
It's taking shares off the market, retiring them.
right. So the total profit is now divided among fewer shares, which means the profit per share, the EPS, automatically goes up.
Even if your actual revenue hasn't grown at all.
And Apple is the undisputed master of this. Since 2013, they have spent over $816 billion on buybacks,
Wow.
retiring nearly 44% of their outstanding shares. That's the engine that has driven so much of its stock performance.
But here's the warning from the sources. Apple's trailing PE ratio is 37.
Higher than Microsoft's.
Exactly. And unlike Microsoft, which is accelerating its growth, Apple's core growth has kind of stalled out recently.
Yeah.
So you're paying a historically high premium for a company that's creating returns more through financial engineering than organic growth.
That's a really interesting contrast with our next consumer powerhouse, Amazon, AMZN.
Yes, the fourth most held stock. Amazon kind of flips the script. It uses its massive consumer business almost as a shield for its real profit engine.
So the consumer side is what we all see, right? The world's biggest online store, billions of visitors. They're on track for over 40% of the entire U.S. e-commerce market in 2025.
Which generates incredible revenue. But retail is a tough, low-margin business.
So where does the actual profit come from?
It comes from one place, mainly. Amazon Web Services or AWS.
The cloud business.
The cloud business.
Oh.
AWS is still the world's #1 cloud platform. It's pacing about $132 billion in annual revenue. And even though it's less than a fifth of Amazon's total sales,
Let me guess.
it consistently brings in over half of the company's entire operating income. It is the profit machine that funds everything else.
And just like with Microsoft, generative AI is expected to just supercharge that growth for AWS.
It should, which makes its valuation story pretty compelling. Compared to its future operating cash flow, especially from AWS, the stock actually looks historically inexpensive.
Okay, so now we get to the final two holdings. And they really show this tension in the retail portfolio. It's the high-risk moonshot versus the ultimate safety net.
We have to start with the moonshot, Tesla, TSLA.
The former #1.
The former #1. And this holding is, I think, less about fundamentals and more about belief, a belief in the vision. It's the definition of high risk, high ambition.
Retail investors love that first mover advantage story. Tesla is still the leading EV maker in North America.
And they're profitable doing it. They've delivered close to 1.8 million cars in back-to-back years. And unlike a lot of legacy automakers, their EV division actually makes money.
But the real excitement, the reason the stock is priced the way it is, isn't just about cars anymore.
No, it's about what's next. It's the promise of a robotaxi network. It's the Optimus humanoid robot.
Right, and the energy business, the storage and generation. People are betting on the vision of Elon Musk.
Which you have to admit is a risky proposition. The sources are pretty clear on this. Tesla is an exceptionally pricey stock, often valued more on dreams than on current reality.
It quotes that Musk has far more unfulfilled promises than visions that have been realized.
which makes it by far the most speculative of these top holdings.
So that makes the final holding even more fascinating because it's the complete opposite.
The polar opposite.
Rounding out the top 6 is the Vanguard S&P 500 ETF, ticker symbol VOO, the safety net.
The most popular ETF among these investors. For anyone listening, an ETF is just a basket of stocks you can buy and sell like a single share. And VOO just tries to copy the S&P 500 index.
So you get instant diversification across 500 of the biggest U.S. companies.
And it is dirt cheap. The expense ratio is just 0.03%.
Okay, what does that mean in real money?
It means for every $1,000 you invest, only 0.30 cents goes to fees each year. 30 cents. It's incredibly efficient.
And the main reason to own it is just raw reliability.
History says so. Over the last 30 years, the S&P 500 has averaged an annual return of about 10.5%.
And here's the real kicker.
Go on.
The S&P 500 has never, not once, had a negative total return over any rolling 20-year period.
So it's the slow, steady winner. It provides the stability while you let your big tech bets either fly or, fail.
We should probably mention that the full Magnificent Seven also includes Alphabet and Meta, who are also huge in AI. But they just didn't crack the specific retail top 5 list.
Which brings it all back to how concentrated this portfolio really is. It's a very specific bet on the future.
Yeah, the trend is crystal clear. They're focusing on dominant cloud players, AWS and Azure.
The AI moat with Nvidia's CUDA, the power of customer loyalty with Apple and Amazon, and then that high-risk bet on Tesla.
And this whole snapshot is really a testament to how the internet just completely changed the game, democratizing access to information that Wall Street used to guard so closely.
For sure. You now have a really clear view of what everyday investors think is best positioned to win in the age of AI and cloud computing.
So this leaves us with a final thought for you to consider.
Retail investors are concentrating a huge amount of their money into 5, highly priced growth stocks while using VOO as a ballast.
So the question is, knowing that the S&P 500 has been so reliable over the long run, what is the necessary trade-off you're making by betting so heavily on these few stocks?
Are you just seeking higher returns in a shorter period of time and accepting the risk that comes with it? Or are you maybe exposing yourself to unnecessary volatility that could be avoided by just sticking with that simple, diversified ETF?
That risk-reward calculation is everything. Thanks for joining us for the deep dive.